Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again Michael Oliver, who's with me almost every week whenever we can find the time to have Michael on. I love to have him on because I think he provides a steady sort of sense of which direction the markets are headed and where the pressures are, and just to help us get ready for what might be lying ahead or what with varying probabilities. I would really like to encourage you to, especially accredited investors who listen to this show, to go to michaelolivermsa.com. That's Oliver, I should say. It's olivermsa.com. To learn more about Michael's work and consider subscribing to his excellent service. Michael has been, he's a veteran technical analyst, but certainly one that does his own creative thinking, creates his own models, and things that he uses are unique. But he was with E.F. Hutton International many years ago. He's had some very prestigious corporate clients in recent years, including Wachovia. And so we're really pleased that Michael takes the time to talk to us. Thanks for joining me again, Michael.
Glad to be here, Jay.
Always good to talk to you. And before we went on the mic, you were talking a little bit about the S&P 500. I noted that it looks like maybe today we won't make a new high. I'm looking at 2124.88 right now on the screen. And we've been making a lot of successive new highs. And, of course, the media has been making a big deal about it, you know. And but you're not convinced that this is nirvana.
Oh, absolutely not. No, I measure markets on various timescales of trend. You can look at a market and see a 3-week rally and say it's up. Well, what's the context? Larger and then larger and so forth. And as far as I'm concerned, in January, the market broke enough stuff on my annual momentum work to say this is a top year, period. The same thing happened in 2000. Now, albeit it took it till August to start down, but once it gave the signal, it said, I'm doomed. It's a dead man walking. It also happened in early 2008. And so you will get rallies. We even made new highs here, but think about this for a minute. Last year's high in mid-December was 2093 on the S&P. It's 5.5 months into the new year, and we traded today all 1.9% above last year's high. So it's not a runaway. Even on the price charts, it's not. I had projected early this year that the high for the year, an optimal place for resistance to come into play in new highs, would be between 2126 and 2130. We've exceeded 2130 a little bit in the last 2 days, but basically we got into that zone yesterday and today. And while I would not outright sell it right here, I would look for vulnerability. Now that we've reached this level, I'm satisfied that the rally could run out of gas here. And basically my advice on a timing basis is the market, the S&P, cannot afford a 2% drop from any monthly high that we've made. Each month we go along, I take about 2% off of it. If you drop that much, you're going to trigger the intermediate factors to the downside, in which case I think then the onslaught begins. And right now I would say if you get into June and you find the S&Ps in the 2090s, 2080s, it's over. Meanwhile, there's more exciting stuff going on in the debt markets.
Well, for sure, and I want to ask you about that. So, but what you're saying really essentially is that 2% basically is nothing. I mean, it can happen in a day, it can happen in a couple of days for sure. Within a week, very, very likely could happen. So we're skating on thin ice, potentially.
That's the way to phrase it, absolutely.
Yeah. Dead man walking, another phrase.
Yeah.
One of the things I love about your work, Michael, and I just tell my listeners, is that not only do you provide some really interesting charts and you show where the momentums are, the lines in the sand essentially, and what's going on there, but also you have some very colorful language. So I appreciate that. It makes numbers and stocks and charts more interesting when you can add some color. Dead man walking, skating on thin ice, and all that. But speaking of skating on thin ice and the markets that you're referring to, much larger. Most people say, well, how's the market doing? They come home from work, how's the market doing? And they think the Dow, or maybe the S&P 500, and if they hear it's a good number, they say, oh, good, I can go have my glass of wine now, I don't have to worry, life is just honky-dory. What is really, though, much important, and what the common folks don't watch as much, is the debt markets, the U.S. Treasury markets, the other, the Bund and the Japanese yen and some of those Japanese, the central banks bonds in Japan. These are all enormous markets compared to compared to our markets. You have a sense of how much larger the debt markets are than the equity markets? I think something like 4 times or something like that.
That's right. I understand too, but it's definitely much larger and therefore, much more gravitational pull there. So if they move, and they've moved in the last 4 weeks, the drop in particular has been sharp in Germany and in the European bonds, Italian, Spanish, and so forth, which were artificially priced off the page on the upside or yields to very low levels by the action of government, not by market forces. That came unhinged. I could see it coming about 4 weeks ago, and it really dropped sharply, especially the bond. The JGB, the Japanese government bond, dropped pretty sharply as well. And our T-notes, our 10-year version, those are 10-year instruments as well, dropped a little less, but still dropped to meaningful levels that look damaging. And I think it's very important because the name of the game for the last several years has been pricing of assets is achieved by central banks, period. All other fundamentals, you can debate them, talk about them, they're meaningless effectively. And investors and asset managers who are probably a level below investors in terms of intelligence, have now subscribed fully to that belief structure. That as long as the CBs are in charge, you just follow along and you'll make your 10% a year or whatever. That jolt in the debt markets was a wake-up call, and it even woke up the ECB this morning. I ran a report today called Big Mistake, to quote Arnold Schwarzenegger, where the ECB spokesman, one of the members of the executive committee, said they're going to increase their QEs for the next month or two. Front load them, he called it. Put more weight into them to buy these bonds. He was upset. Too bad, but he was upset at the speed of the decline in those debt markets. I think it's very revealing because what it says is despite the ongoing purchase of those instruments by the ECB, those markets got trashed, and they did so rapidly. What he admitted, and that's why I said it was a big mistake on his part, was that they had insufficient ammunition to stop market forces, and that's why they're having to increase their ammunition loads over the next few months. Now, that's the kind of thing that can cause that belief structure that exists among asset managers and investors to start to crumble, and have ramifications in the equity arena and so forth. And I think it's begun. I think the crumbling of that belief structure has begun.
Well, they will come in, though, with more, a bigger bazooka, perhaps, and they'll hit the markets with more and try to buy some more time, though, won't they?
Well, it could. I could make an argument that the drop in those instruments right now has already done enough for the time being, and you could have some congestion, maybe a little rally and so forth and so on, and it would make sense. But the damage done is pretty serious. It's not the kind of thing that says, oh, it's just over with now, we go back up. No, there are legs broken there, and I think that any rally is a failing rally now. But you also have to remember if you're shorting those markets, I particularly wouldn't do that. I use them as a tool to analyze this process, this belief structure process, and its breaking up, and how it would affect equities. But you realize if the equity markets actually catch cold because of this, and do it rapidly, let's say you have a 10% down month at some point, these instruments are going to rally, because there will be a flight to safety again. Now, they'll rally to a lower high, no doubt, these debt markets, but there could be a flood of shaken out money from the equity markets moving back into these debt markets on a brief flight to quality rally. So even though rates, I think, are going up, prices down in those instruments, it could be irregular.
Sure, and which is why you're not recommending shorting the long bond. I understand that. That certainly makes sense, but one of the things I've noticed, Michael, is that recently, it used to be pretty clear-cut. When the equity markets were down, money flowed into U.S. Treasuries and vice versa. What I've noticed more recently, though, we've had days when a substantial amount of money comes out of both equities and the U.S. Treasuries, which seems to be akin to what you're talking about, potentially loss of belief system, loss of confidence. And maybe it was going into the commodities, maybe a little into gold. I don't know where it was going, real estate, whatever. It was going somewhere other than So very, very interesting. So the U.S. Treasuries, what do you have any key numbers there? What we should be looking for? I know you watch the 10-year Treasury as your key, and why, by the way, do you watch that more carefully than say the 20 or 30-year bond?
Well, I'm an ex-futures guy, for many decades, and
sure.
The T-bond futures were where I always focused. But the funny thing happened there: the rotation from the March to the June contract, to March contract this year went off, and the June is now the front month, created about a 15-point up move in the price simply by rotation. It was caused by, as I understand it, a insufficient quantity of deliverable bonds against the contract due to a period back in the Bush administration where 30 years weren't issued.
Yeah.
So there was sort of a gap in the supply, and therefore it created this rise, and it sort of distorted the charts. Okay. And I then decided, well, heck, everybody's looking at bonds, that's 10-year. They're looking at the JGB, which is a 10-year. Why not focus, therefore, on the U.S. 10-year as well? And so I look at the T-note futures. And they're trading either side of 127. And I don't think you can close the week out around this level. If you do, I think it is joined in with the bonds and the JGB in saying, I'm doing serious damage. Now, it doesn't have to pay off right away, but it's negative action.
Okay, so more broken legs in the bond market.
Broken legs, yes.
Yeah, we talk about and 127. I think 127.25 or 127 on a weekly basis was your key last week. I noticed we were into the 126 something earlier today, but bounced back up before we went on the show. So that's the number to watch then. 127 on the 10-year, huh?
Weekly close around there, I'd say it's too low. It indicates future downside, future rise in rates, future downside in price.
All right, with a few minutes left, we can't let you go without getting your latest view on gold. Gold was showing a lot of strength till today, and as seems to happen so often, before London goes home for the day, they smack the market down really hard. I saw we went down to, something like 1207 or something like that. We're up at 1220, even 1230 in Asia. I don't know this morning or yesterday morning, but it's been a pretty strong gold market the last few trading sessions. What's your take on gold now?
I think it overcame last week's close. I think last week's close overcame one of my first primary hurdles, the three-quarter average, which happened to be a level that it bumped and couldn't get above. It closed above it last week. That's 1218. Staying above it isn't essential. It broke through the hurdle, and I think you have to treat gold like you do the S&P right now. It's in a quagmire. It really is a tight-fisted situation where there's about 3 or 4% swing between the highs and lows of gold over the last several months. That's all. And so it's very much contained. It seems to be wandering, but in my view, it's edging upward, and I think the S&P, with a sneeze here, will be clearly going downward. So I think you've got to take the day-to-day stuff sort of with a grain of salt. My big number on gold remains for the rest of this quarter, getting up to 1255, particularly in a weekly or a monthly close. We had a high yesterday of 1232, so it isn't all that far above the market.
Yeah.
And I think if we see that, a bull market in gold has emerged, period.
So we see some equity market weakness. Your sense is that we probably see some of that money flowing into the treasuries. Maybe some of it might escape into gold as well.
The treasuries, I think, that will go into there only if you got a dramatic down day in the S&P, not a 10, 20 pointer, but if all of a sudden you had a little mini crash type event of a 10% drop rapidly in a period of a week or so, I think then you would scare folks. It would take something noisy like that, I think, to actually push enough money back into the T-notes and so forth. Not just the down in the S&P, but the speed of it. I think that would be the issue, is whether money would fly to the notes temporarily. And I think gold will be a beneficiary of this asset reallocation. I think commodities in general will also, with some being leaders, some not, but will be beneficiaries of an asset class shift here.
Mm-hmm. Well, if you had higher interest rates, that would make sense if it went along with commodities, because it would sort of, I suggest to me at least, that it was a loss of confidence in financial assets perhaps, and in the central bank essentially. The question is whether this comes all of a sudden or whether it's a gradual demise of confidence in the central banks. What are your thoughts?
I'm a believer in chaos theory, and I happen to believe that the incrementalism that people have gotten accustomed to over the last few years, because it seems to have been controlled and engineered by the central banks in an incremental way, I think it comes undone rapidly. It wouldn't shock me that in a matter of 2-3 weeks, dramatic price moves could occur if the right triggers are hit first. And like I said, on the S&P, it's about 2% below the market. You could be hitting those triggers. And I would not expect an incremental decline, at least the first leg. I would expect something ungentlemanly.
Okay, well, that's exciting for traders anyway, but you want to be ready for those things, and that's why we thank you very much for coming on, sharing your insights, Michael. Very, very greatly appreciated. Just one last quick question. Oil, you saw as sort of a laggard in terms of the turnaround, I think, in commodities. Do you still see it that way? Have we seen the bottoms in oil?
I think it's going to be quagmired. I have various reasons to assume the following statement, but I think you'll see oil trading at $57 next quarter, which means right around today's low. So if we sell off from here between now and the end of the quarter, I suspect sometime next quarter you're coming back up here, or you'll linger at this level until you get into July. There's certain reasons to do that, but then at that point, starting next quarter, I think another leg down in oil could occur. Now, I'm not at all confident that that means a new low. Just some kind of serious leg of decline, possibly down to 50 or even the high 40s. And that there's technical reasons for this. So I do think oil is in a basing process, but it's now near the upper end of the basing process and is likely to have another leg back into the lower end of the basing process. That's something that we should see in the next quarter.
Okay, so quagmire is the key word there with respect to the oil markets. It's very good. Well, thanks again, Michael, for being with us, and always a pleasure to have you on and have your views shared with our listeners. Thank you very much. We'll look forward to talking to you hopefully next week again.
Thank you, Jay. Bye-bye.